Now, while Powell's term doesn't end until May, the administration started naming potential successors earlier this year with 11 candidates originally under consideration. Starting next year, 4 new presidents will be voting members on the FOMC. Joining me now is Neil Dutta, head of economic research at Renaissance Macro, along with our Steve Leisman. Guys, an early Happy New Year to both of you. Neil, how dramatic do you expect this change at the Fed to be?
Well, I mean, typically, it's continuity is key. Obviously, that's not what we're seeing right now, and it's unlikely to be the case. But the one thing I would just say, John, is that if you think the president is just going to be able to put in whoever it is he wants and that he's going to get a dovish policy outcome as a result, I would tend to resist that approach. I do think you do have a lot of sort of heavy hitters coming into the Fed, particularly among the regional Fed presidents, folks like Lori Logan, Beth Hammack, and they're not going to be convinced that it makes sense to ease policy significantly on the anticipation of some sort of economic golden age or some kind of productivity boom. I don't think they're going to be convinced of that. I mean, most economists sort of take a show me the money type approach. I mean, you can't just start front-running things you have yet to see. And there's a lot of enthusiasm for a productivity boom, but that's not yet, in my opinion, in the data. And they're going to want to wait for that before they start doing anything about it.
Steve Leisman, yesterday, your pencil was still working. Your pencil wasn't down yet. You weren't ready to share what you thought was coming up. Have you worked it out? Is your reporting done enough?
I'm still working it out, John, and it's still a major question. I'll be reporting in depth on this on Friday, we decided, because they didn't want me not to have to work on the New Year's Day. So, it's the question being, will Jay Powell stick around? He'll still have 2 years left on his governorship. Of course, his term as chair ends in May. But as for expectations, I think it's really interesting, John, to look at the Fed funds outlook. And you don't see a whole lot in there. If you take a look at this chart, what this chart tells is a story. The story is this. Probably, perhaps, Powell does one more cut before he leaves in May. And then a new guy comes in. It will be a guy, I can say that, and probably cuts once more. And then you see their December, John, it's still a 3% funds rate in the futures market. And in fact, I don't show it there, but if you extend it to 27, it's still 3%. So there's an expectation, and this may be picking up on precisely what Neil was talking about, which is that whomever you put in there, they still have a committee to deal with. This committee is still going to be beholden to the kinds of ways that they make policy based on a Fed funds model and their expectations for interest rates, as well as their inflation expectations. And that there's only so much this chair can do in terms of being able to want a policy, but not necessarily be able to get that policy into effect, because they have to bring the committee along, and you don't want a chair that's either going to, A, be Arthur Burns, the famous Fed chair who gave us inflation that Volcker had to vanquish, or B, have votes like 7-5 or 8-4 consistently with your committee against you.
Neil, what does the Fed do about this K-shaped economy, or is there very little that they can do? I mean, it's this constant tug of war between the labor market and inflation concerns, but which way do you go, and what's the key data in the first half of the year that holds the most sway?
Well, I'm sort of, I think, in the minority among my peers, but I don't think there's really much of a tension, and I think that'll be revealed in the data as we go into next year. The Fed currently has on the board one rate cut, I think, in the median projection for 26. And historically, frankly, it's been a reliable thing to sort of bet against that. And I don't think the goals are really in tension. I mean, if you look at what consumers are saying about the job market, job finding rates are getting very difficult. So even though initial claims are low, it hasn't kept the unemployment rate from going up all year. And I suspect that continues. The housing market, despite lower mortgage rates and Fed cuts, builders are going into the new year with the most unsold inventory since 2010. So for me, it's housing and labor. We're talking about the markets, take a look at home building stocks or Lennar going into the end of the year. It's not necessarily an encouraging thing.
Not at all.
As labor markets get more slack, I think that'll take care of the inflation that everyone's so worried about.